Welcome back to Investing Talk Podcast.
Today we're looking at NextEra Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so let's just start at the top. NextEra Energy has always had this reputation, this dual identity. For years, the promise has been you get the safety of a regulated utility, but also the growth of a tech company. The big question is that still true?
That's exactly the tension we need to unpack. I mean, is that premium valuation really deserved today? When you look under the hood, you see it's not just two businesses running side by side.
Right.
It's more of a symbiotic financial engine.
So break that down for us. You have Florida Power and Light, the regulated utility, and then NextEra Energy Resources, which is the huge renewables arm. What does FTL actually bring to the table beyond just being, stable?
FPL is the bedrock. It's the foundation, and honestly, it's kind of like the internal bank.
The bank, okay.
Yeah, it gives them incredibly predictable cash flows from a high-growth state like Florida. And that stability, that predictability, lets the parent company, NextEra, get much, much lower financing costs for its huge renewable projects.
So cheaper capital.
Exactly. Cheaper than any pure-play solar or wind company could ever hope to get. And that, right there, is their biggest competitive advantage.
And that operational strength really came through in their latest results, didn't it? The Q3 2025 numbers were strong despite everything going on.
They absolutely were. They posted operational earnings per share of $1.13. The consensus on the street was, what, $1.04?
So a pretty significant beat.
A huge beat. And yeah, the top-line revenue was a little soft, but beating on earnings like that just proves they have incredible cost control, and they're just executing really well.
And you see that efficiency in the other metrics, too.
You do. Their return on equity, or ROE, is just under 15%. I mean, for context, most utilities are thrilled to get into the low teens. So it just confirms they're deploying capital way more efficiently than their peers.
Okay, so that's the stable side. Let's pivot to the growth engine, the renewables part. This is where those big structural tailwinds come in.
Right. And they are, without a doubt, the leader in U.S. renewables. Wind and solar.
And that's not just because they're big.
No, it's because they were early, they have the scale, and they're masters at keeping costs down. But the really interesting part now is the demand side. It's not just about clean energy mandates anymore.
You're talking about the AI and data center boom.
Precisely. It's a total game changer. These massive data centers, the hyperscalers, they need enormous, reliable amounts of power. And they want that power to be green.
And NextEra is perfectly positioned to supply that.
Perfectly.
Yeah.
And that's what gives management the confidence to stick with their long-term promise. They're reaffirming guidance of at least 6 to 8% annual EPS growth all the way through 2027.
Which is incredible for a utility.
It is. And that growth profile is why so many investors see it as this rare blend. A dividend stock that acts like a growth stock.
And the dividend history is pretty remarkable.
31 straight years of dividend increases.
31 years.
With a 10-year average growth rate of about 11%. It's phenomenal. Their last quarterly dividend was just over 56 cents, which gives it a yield of about 2.7% right now.
But, okay, here's where we have to challenge the story. You're paying a price for all this good news. The valuation, the forward PE, is sitting at around 22.4.
Yeah, that's definitely a premium. The sector median for utilities is closer to 20 times earnings.
So the market is pricing in that growth.
It is. It's willing to pay up for that 6 to 8% growth visibility and the best-in-class renewables exposure. And analysts seem to agree the average price target is around $91, $92.
Which implies maybe a 7 to 9% upside from here.
Something like that, yeah.
But that premium price, it brings us right to what I think is the most important risk to look at. The dividend sustainability. We know these projects cost a ton of money, and yet their payout ratio is pretty high.
It is. It was recently at 79%.
79, that's pushing it for a utility.
It's way outside the comfort zone.
Yeah.
Most utilities want to be in that 60 to 70% range. It's a strategic tightrope they're walking.
A tightrope, that's a good way to put it.
They're clearly choosing to reward the income investors. But it leaves less cash on the table to reinvest in the new projects that they need to actually hit those growth targets. If earnings slip, that high payout is the first thing that's going to cause some stress.
Okay, so looking ahead, what should we be watching for over the next, say, few months? What are the big catalysts?
The main anchor event is their Q4 earnings report. That's probably coming in late January 2026.
What's the market looking for there?
They'll be scrutinizing it for any sign that the operational momentum is slowing down. And of course, everyone will be listening to management's tone, especially around those 2027 growth targets.
Okay, and beyond the company's own reporting?
You'll see a lot of institutional activity, as we get to the end of the year and into January. You have a lot of ETF rebalancing.
Right.
And that kind of structural buying and selling in a big, heavily weighted stock like this can create some volume and get it back on people's radar.
Now let's get into let's call it the market chatter, the rumors. We have to be clear, this is all speculation.
Absolutely, unconfirmed. But the biggest whisper is about accelerated expansion.
Meaning what, exactly?
The chatter is that they might be deploying some of their big solar and battery storage projects in Florida and Texas even faster than their current aggressive timeline. If they beat their own schedule, that's a material upside surprise.
And with the company this big, there's always M&A talk.
Always. The persistent talk is around bolt-on acquisitions, maybe buying some smaller distributed energy companies or regional utility to expand their footprint.
Okay, and the last rumor ties back to what you were saying about data centers.
This is the big one. The ultimate home run would be confirming a major long-term supply agreement with one of the hyperscalers.
Like a Google or an Amazon.
Exactly. A huge deal to power new data centers would just lock in demand for years and would, I think, justify that premium valuation several times over.
And just quickly, on a technical level, the chart looks pretty good right now.
It does, yeah. The stock has reclaimed both its 50-day and 200-day moving averages. That confirms a solid uptrend.
And we've seen strong support in that $76 to $80 range. Dips seem to be getting bought up. But to be balanced, we have to talk about the real risks here. We mentioned the payout ratio. What else?
Well, the biggest one, the one that's always there, is regulatory risk.
Specifically in Florida.
Correct. Any adverse ruling from Florida regulators that impacts FPL's allowed return on equity, that's the single largest threat to the whole foundation of the stock. They're good at navigating it, but the risk is constant.
And the other big one is just the macro environment, interest rates.
Always a headwind for utilities. It just makes it more expensive to build all those capital-intensive projects. It can pressure the whole sector.
Is there any kind of cushion there?
A small one. The stock's beta is quite low, around 0.74. That suggests it holds up better than its peers during, big market shocks or periods of uncertainty.
So if you were to kind of synthesize all of this, what's the core investment case here?
I think it comes down to this. You have world-class execution, which we saw in that Q3 beat, combined with this unmatched structural advantage in the fastest-growing part of the energy market. The thesis is that the premium price is justified by both the stable income and that very clear 6-8% growth runway.
So it's a story of innovation meeting massive scale. And with all these catalysts coming up, from the Q4 earnings to the chatter around tech partnerships, it seems like there's a compelling case for both the short-term traders and the long-term holders.
And I'll leave you with a final thought on that. The demand from big tech for clean energy to power their data centers, that is a generational shift. It's massive. So considering Nextera's unique scale, how quickly could that demand force them to accelerate their growth even faster than that already aggressive 6-8%? A major deal confirming that trend, well, that's the ultimate upside surprise that could really change the game for this stock.